Ladies and gentlemen, thank you for standing by. Welcome to the FASB IASB Revenue Recognition Exposure Draft Part 2 conference call. During the presentation, all participants will be in a listen-only mode. If at any time during the conference you need to reach an operator, please press *0. As a reminder, this conference is being recorded Tuesday, April the 26th, 2011. I would now like to turn the conference over to Dave Langley, National Sales Manager. Please go ahead, sir.
Hello, everyone, and thank you for joining us this morning for our webinar, New Updates for the Financial Accounting Standards Board and International Accounting Standards Board Revenue Recognition Exposure Draft, featuring our guest speaker, Dr. Tony Sondhi. For those of you that are not aware, Tony is a member of the Emerging Issues Task Force of the Financial Accounting Standards Board. He is also a member of the Expert Advisory Panel on Fair Value of the International Accounting Standards Board. He's been a member of the Global Financial Reporting Advocacy Committee of the CFA Institute, the Accounting Standards Executive Committee, the Financial Accounting Policy Committee of the CFA, and many more, and I simply don't have time to cover his whole resume because he has done so much. In addition, Tony is a professor and an author. He's the co-author of the CCH Revenue Recognition Guide and the Analysis and Use of Financial Statements, 3rd edition, and he's been published on all kinds of other things. If you'd like more information on that, Tony will be pointing out his website at the end of his presentation, and you can find that information on his website. The agenda today is pretty straightforward. We've covered who I am and who the guest speaker is, so I think we're off to a pretty good start. I'm going to run through a small slide deck to cover the SOFTRAX billing and revenue platform, and then Tony will cover the exposure draft. As you all know, the Financial Accounting Standards Board and the International Accounting Standards Board have issued proposed changes to revenue recognition. Some of the areas that Tony will be addressing are listed on this slide, things like the basic model, significant changes, contracts, and so on. At the end of the presentation, we hope to have time for a brief Q&A session. You can submit questions via the Ask a Question feature located in the lower left corner of your webcast console. Upon conclusion of the presentation, you will receive an email, and give us a little bit of time to get that email out, I'd say up to 2 hours, where you will have a link to a webcast feedback questionnaire. This is important for those of you that are interested in the CPE Credit, because this is where you will click a box on that screen to request that CPE Credit. A second email will go out within 24 hours with the slides that you're viewing today, as well as a link to this recorded webinar. I'm going to say it one more time because probably the responses that come back to us, the question that will be asked the most is, how do I get my CPE credit? Wait for the email to arrive, click on the link, check off the CPE request box located in the top corner of the questionnaire, and that'll take care of that credit. I'm guessing that most of you are not aware that SOFTRAX manages billions of dollars with its billing and revenue recognition solution. Hundreds of companies have used SOFTRAX solutions for billing and revenue recognition. So I guess the question is, why? Well, SOFTRAX helps in 3 main areas. One is billing and operational efficiencies by helping to automate contract renewals, contract management, complex billing, and order management. The second area is with revenue recognition and compliance. I mean, that's kind of the reason we're all here today, to listen to Tony. And the third is by offering comprehensive reporting and analysis. Now, I want to tell you just a brief story about the first time I met Tony. We were doing a seminar down in Austin, Texas, and I believe the topic was 08-1 and 09-3 compliant guidelines. And it was a very similar format. I covered SOFTRAX, I introed Tony, he did his bit, went off without a hitch. It was a great crowd. Tony and I shared a cab back to the airport together, and he's just a very easy man to talk to. On the way back, we talked about everything, the seminar, other seminars he had done, the topics at hand, his home in Florida, how he got his mortgage, my background. And as we approached the airport, Tony said something to me. He said, Dave, I think your message was a little off. And I said, what? He goes, no, don't get me wrong. You did a great job. Fantastic job. You covered SOFTRAX really well. He goes, but you talked exclusively about compliance. And he said, certainly that's why we are all here, to discuss compliance. He actually said it's a pain in the butt and something we have to deal with. He goes, but the value of your platform is that it gives the companies the data they need accurately and timely so they can make the decisions they need to make to run their business better. So let's talk a little bit about those advantages. We've already mentioned operational efficiencies, compliance, and reporting and analysis. Let's break it down a little bit. What does that mean? Well, we help you increase revenue, or at least confidently what revenue you can report, and making sure that you don't lose revenue in the process. We do this cost effectively because we get people out of spreadsheets and inefficient methodologies for trying to manage this, and we help avoid costly restatements come audit time. So you're managing to compliance. There have been lots of studies and papers written on the challenges of managing the revenue process. It rates as one of the most complex areas to manage in accounting departments because it's just simply very difficult to establish internal controls, as most enterprise applications today just don't do it well. Some of them don't do it at all. Many companies are relying on disconnected systems, a lot of Excel spreadsheets, and error-prone human intervention to try and handle this. So without automation, you're dealing with all the risk, and there have been some big-name companies that have not handled their compliance correctly and have been forced to restate their numbers. Most of the companies we talk to have serious delays in trying to close out their books on a monthly basis. And all of this leads to one glaring fact, a discussion I had with Tony in that cab in Austin going back to the airport, is you can't make good decisions if you have bad or not timely data. And it's not getting any easier. The challenges continue to grow with ever-changing standards. The key to the SOFTRAX solution is that it was designed with the understanding that order to revenue is separate and distinct from order to cash. So typically when I do this type of a presentation, I'm more in a one-on-one with a company that's come to us because they're facing challenges related to revenue recognition. And at this point, I'm sitting across from a CFO, and I pull out the reports that you can get out of the SOFTRAX system. And I don't have time to do that today. So what I'm going to do is raise this up to about 50,000 feet and talk about the keys to successful revenue management. First, you need to establish a fair value selling price, and this needs to be optimized across multiple attributes so that when you do your revenue allocation, you're using the appropriate selling price to do that allocation. All of this ensuring compliance, and we do this with a comprehensive audit trail built into the system, and by giving you the tools necessary to consistently apply your guidance across all of your transactions. This enables you to have a flexible pricing and packaging model while ensuring revenue accuracy. Now, there are certainly other things we could discuss. Once again, we're limited on time. Other governance, risk, and compliance considerations, and I'll let you look at the the bullets here. I'm not going to read them off. I'm simply going to state that that bottom line, you can align the revenue process with the SOX 404 requirements. Once again, if you're interested in learning more about SOFTRAX, we'll have, at the end of the presentation, I'll cover who to contact and where you can go on our website to find that information. At this point, what I'd like to do is introduce Tony Sondhi. Tony, are you ready?
Yes, I am. Thank you, Dave. Hello, everyone. Thank you very much for being here today. This is the second in a series of webcasts that I've offered here. It's a second in the series on revenue recognition, the exposure draft, and that's what I want to effectively show you and discuss a few things. You may recall what we talked about the last time, and hopefully many of you were here the last time, and if those of you who couldn't make it were able to attend or listen in on the archived webcast, because obviously it's not going to be possible to repeat the material from the last time. So I just wanted to get that out of the way. Keep in mind this is the second part. This is part of a series where I hope to explain to you the different components of this exposure draft. Now, although it says exposure draft, obviously I have been following what the boards have been discussing, what the staff has been doing. I've also gone through many of the comment letters, reviewed them, and analyzed them for what people were looking for and what kinds of information they will be asking about and thinking about. Now, so in the sense that this is more than the exposure draft, you could say that the slide title itself that you see up there, it's only partly correct because I'm talking about where they are. In addition, I should mention that as part of an analyst committee that I serve on, I have in February met with the FASB to discuss this, and earlier this month I met with the International Accounting Standards Board in London and their staff and discussed revenue recognition. I've also been in touch with the staff on a couple of other issues with respect to this. The other thing, of course, is that although this is on revenue recognition, I do offer seminars and webcasts on a whole host of different topics, leasing, for example, securitizations, consolidations, and so on. But there is a lot of work to do here, so let's get to that. And let me just remind you of the basic model that the boards have proposed, keeping in mind that the fundamental objective of the boards was to try to come up with a single revenue recognition standard single standard for revenue recognition. Because at the moment we've got, in the U.S. at least, a number, more than 100 different accounting standards. And the IASB at the same time only has 2, and they're very broad and they're sort of generalized, I guess is the best way to put it. And so what they're trying to do is to come up with a basic model that would identify the contracts that the company has with the customer. Within those contracts, it'll show you how to identify the different performance obligations, because it is these performance obligations for which you will be recognizing revenue once this becomes a standard. Of course, after you've identified the separate performance obligations, you will then determine the transaction price. That transaction price then has to be allocated to each of the separate performance obligations that were identified in the second step. And then you're going to recognize revenue as each of those performance obligations is satisfied. In some cases, of course, it could be upon completion of the work. In some cases, it could be a continuous transfer. But that's just the basic model. We've discussed aspects of this in the previous webcast. What I want to do today is talk about what the exposure draft was looking at, what it had proposed, as well as some of the changes. Now, please be very, very careful with these changes. They're not necessarily final. Many of them are tentative decisions, the board and the staff. In each case, the FASB and the IASB continues to work on this. But obviously, that's what makes this one of the most critical standards, because the changes that are coming are rather significant in all cases. So in that sense, not only do you need to be aware of what the what the exposure draft said, but you also need to be aware of what's happening in each of the meetings, subsequent meetings. So every month when the boards meet, every month when the staff issues new papers explaining issues, changes, etc., all of that has to be followed. So this, in a sense, is a distillation of all of that material. What I want to do today is talk about some of the issues related to the following topics: combination and modification of contracts. And I'm going to show you a few things with respect to those. Identification of the separate performance obligations. What did the exposure draft say? What are the changes? transaction price, I want to deal today with three issues. How are we going to deal with the time value of money? What are you going to do with respect to collectability? And how does uncertain consideration affect the amount that you recognize ultimately as revenue? The fourth major issue that I want to talk about is the allocation of the transfer price itself. And then we'll close out with a brief discussion of continuous transfers. Okay? So let's begin with the first one. Now, the contract with the customer. Fundamentally here, the principle is that you will need to combine two or more contracts that were entered into at or near the same time, so long as one of these three conditions is satisfied. So the first point is, if the contracts are negotiated as a package, and these different contracts that are negotiated as a package have a single commercial objective, then you effectively have to combine them. So the fact that you break it up into X number of SOWs, purchase orders, etc., is not the point. The fundamental thing is, were they negotiated as a single package with a single commercial objective in mind? Another possibility is that a consideration that the seller expects to receive and the customer is obligated to pay in one contract depends on one or more other contracts. So if you combine, in other words, if you relate, I should say, two or more contracts with respect to the consideration in any one of the contracts, then you're going to have to combine them. Finally, goods and services in a contract are related in terms of design, technology, and or function. Now, please keep in mind this is something that, if you've listened to at least one of my webcasts on revenue recognition, I'm sure you've come across this because I've talked about this. I think this is an important issue, and that's what obviously enough people have said in the comment letters that this is now included. However, there's a very, very important point that I make at the bottom of this slide where I note that segmentation criteria that were based on price independence of the performance obligations within a single contract have been eliminated. So now segmentation is going to be achieved through the allocation rather than through price issues and other indicators. So this is a significant change. The next point that I want to make here is, how do we account for modifications? The current proposal, as it stands, with the amended exposure draft, in other words, says that you would treat a modification as a separate contract if the price of the modification is commensurate with the value of that incremental purchase obligation. If that's not the case, then you would combine it with the existing contract and reallocate the arrangement consideration to the different performance obligations that were identified when you were evaluating the contract and in the earlier steps, as I pointed out. Now, let me mention one other thing here. It's very, very important to think about the meaning of the term, commensurate with the value of the performance obligation. And so you're going to have to compare the price of the modification, the incremental amount charged, with the incremental performance obligation. Now, what I'm in the process of doing is working through various different examples of how this is going to affect issues and what is it going to mean for revenue recognition, for financial reporting going forward. But at this point, all I want to do is effectively sort of give you a heads up about the accounting for modifications. Okay. Now, at this point, let's do the first polling question, Dave. I think this would be a good place to do that. Excellent. So now for the audience, please submit your answer to this polling question. The poll will remain open for another few seconds, and then Dave will tell us about the responses that we've received. As you can see, it's about the contract modification. Do you see the proposed accounting as clear and operational, Or do you think it is not clear and it would result in inconsistent application? Or maybe you think that it's likely to result in significant restatements, right? So the first answer, of course, says it's clear and operational, which means it will not present issues of either that are mentioned in either of the second or the third choices. Okay. So, Dave, maybe we can take a look at it now.
Yeah, it's coming up here.
Okay, there we go. Thank you. And so 38.7% of the audience feels that it's clear and operational, and about half feel that it is not, or at least it's unclear, and then we've got about 10.9% going for the possibility that it would result in significant restatements. Now, to me, what that tells me, Dave, is that, this is obviously something that our audience will have to be very careful about. So I think that was excellent. Great. Thank you. So I'm now going to move on and take a look at the next issue. So my second issue, as you recall, is that I was going to discuss separate performance obligations. Now, the fundamental principle, again, let's begin with that. A performance obligation should be accounted for separately only if it's distinct from others in the contract. So the point here is, or the issue that you have to be very clear about is the meaning of distinct. There are two indicators provided. Either the pattern of transfer for one performance obligation is different from other obligations in the same arrangement, same contract, or alternatively, the good or the product or the service has a distinct function. So as you can see in what I mentioned last time in the first of these series, as this is somewhat similar to standalone value that we have today. But obviously, it's a different set of indicators. And just a little bit more on that, on the second one, which is that the product or service should have a distinct function. And this is where it becomes much closer to the standalone value. And here the point is that you should consider that it has a product or a service, a good or a service. In other words, an obligation has a distinct function if it is regularly sold all by itself by the vendor, right? Now, that one, as you can see, is quite similar to what we were talking about in standalone value under 081 and prior to that under 0021. Now, the customer can also alternatively use the good or service on its own or together with resources that are readily available to the customer, right? So now the fundamental change here is that you no longer will be required to evaluate whether the purchase orders have separate risks, which is a big difference because obviously a lot of people were concerned about how effectively that could be done. Then the exception, though, that I want to provide here, and this is something that I'd like everyone to be very, very clear about. Fundamentally, the construction industry, the software industry, cloud computing, these are the different possibilities that come to mind. So the exception is that if you have agreed to provide a service which involves integrating promised goods and or services into a single item or a single deliverable, then the entire contract would be accounted for as a single performance obligation. So as we said here, please consider carefully those of you who are in the construction contracting business, those of you who are in software, customized software arrangements, and this again, let me remind you, is an area where I'm working on developing different examples and looking at the different industries that I work with as an advisor to different companies and developing the implications of this particular exception. And I think this is going to have a rather significant impact on financial reporting as well once this standard is adopted. Okay? Then the time value of money. Now we're talking about transaction price. You'll recall I pointed out there were three different issues: the time value of money, collectability, and the issues related to uncertain consideration. Now, with respect to the time value of money, the first point is, the principle is that you would adjust the amount that you expect to receive from the customer as consideration in the event that effectively the contract contains a significant financing component. So the amount of the consideration you get, part of it at least, is financing. How do you determine that? Some issues that are raised and discussed, for example, the cash consideration that you get on day one, or that is at the time of the transfer of the product or service, that would be very different than the consideration you're actually going to receive. Second, there's a significant timing difference between the transfer, in the timing of the transfer and the receipt of payment, or when it becomes due, I should have said, sorry. And then finally, if an interest rate is either explicit or implicit in the amount that the customer has agreed to pay. Now, please keep in mind, this in essence applies, this requirement, only when the timing of the transfer versus the payment exceeds 1 year, right? So to some extent, those of you who are steeped in the knowledge of technical practice aids in software will recognize this because this is what we're talking about, extended payment terms and so on. But this is where you have to be very careful with respect to the application of the time value of money concept. The second point that I'd mentioned with respect to transaction prices has to do with collectability. Now, there are three principles here. Collectability is no longer a recognition issue. For measurement, on the other hand, you will not adjust the amount of the consideration you expect to receive for customers' credit risk. You will instead recognize an allowance for all expected credit-related losses as a separate account, contra revenue. In other words, you will recognize the impairment of the amount, the asset that you expect to receive once the customer pays up. So this is a huge difference in the way we treat collectability from today, okay? And then finally, the third point that I want you to think about is uncertain consideration. Now, depending on the type of transactions you have, the amount of experience you have, you will determine or estimate the total amount of the consideration to which you're entitled under the contract using either a probability-weighted method or the most likely. Now, I can tell you one thing, that based on the discussions that I've had on several accounting standards, it's going to be very, very interesting to see which one of these most companies end up in. But the point is that you are going to have to start thinking about the data that you need, the documentation that you need in order to apply this uncertain consideration issue. Okay. Now, before we go on to the other issues that I wanted to raise with you, let me put in or ask Dave to put in another polling question. So this would be a great point to do that. So there we go. Now, this one, what I wanted to get a sense from you is that what selling price do you expect to use? So let's assume this exposure draft becomes a standard. The question is, what are you going to do? Will you be able to use WISO of selling price based on standalone sales prices? Or do you think you're going to have, at least as part of your evidence, you're going to use third-party evidence? And finally, do you think that much of what you do will be based on an internally developed best estimate of the selling price? Okay, so those are the three questions, and hopefully you have that there on your screens. And if we'll give you a few seconds to start thinking about this. Now, in the meantime, what I'm going to do is, again, keep in mind these are the three choices, but I want to be very clear. Third-party evidence is only, in a sense, part of the information that you use to come up with prices. But the question I'm asking is, what do you think is going to be a principal source of information that you're going to use. Is it going to be VSO? Are you going to look at what others, of course, those entities, those sellers who are not selling into commodity businesses are unlikely to find comparable transactions elsewhere. So for them, their ability to use the third-party evidence is, of course, limited. And then, of course, the third possibility is the internally developed best estimate of the selling price. So that's what I wanted to give you as a question, get a sense of it, and there we go. So 33%, one-third fully expect to use VSO, and 58.5% intend to use the expect to use internally developed estimated selling prices. And, I'm not actually surprised by this because I did think that there would be a preponderance of folks who would be using this. And I'm not surprised by the third-party evidence either. The VSO, by the way, I agree that there will be companies who will use it. My concern, in a sense, is what's going to happen over time to this percentage of companies using VSO, right? So that's something that I think might be interesting to consider. Thank you, Dave. I'm now going to move on to the next three issues that we have, or two, was it? A little bit more on the transaction price, okay? Now here, please keep in mind that you recognize revenue in terms, at the amount that's allocated to a performance obligation on which performance has been satisfied or completed, unless you're not reasonably assured that you will be able to get that amount. Why would that happen? If the customer has the ability to avoid payment, but not by breaching the contract, without that. Second, if you don't have experience with similar types of contracts. In other words, this is a new vertical that you're selling into. It's a new part of the business. You've got a new geography that you're selling into, or you've changed distribution channels, for example, among many possibilities. And finally, the third possibility is that you have experience, but you don't have much predictive ability, right? So the problem is that although you've done this before, your prices are highly variable, or the amounts that you end up collecting are highly variable, and so on. So that's something to be concerned about. Now we come to the next topic, which is the allocation of the transaction price. Now, the best evidence, of course, is observable separate transactions. And what you need to do is, in the event you don't have observable separate transactions, or you don't have good data on that, that's when you will be using or developing an estimate of the selling price. Now, on the other hand, one of the things that they've added recently is that if the selling price for a performance obligation is highly variable, and the staff cites as examples intellectual property transactions and software transactions, then you would be permitted to use the residual method. Now, please keep in mind that this is similar to the guidance that we have in SOP 98-9 on software transactions. It's similar to what we had in 0021, but please keep in mind no longer available to us in 081. So here we're talking about the ability to use residual method under certain circumstances for some industries, and the methodology is similar to current guidance in 98-9, except that standalone selling price data for all other performance obligations in the contract will be needed to effectively apply the allocation process. So this is something I think you're going to need to think about. We need to think about some issues that will arise with respect to the residual technique. And, of course, a fundamental question is, how do we leave it? How do we determine that, what is it about software and IP that is so different that we should be using the residual method there but not elsewhere, right? So that's another area that I think is going to require careful consideration. Then allocation. Now, you should allocate a portion off or the change in the transaction price entirely to either a single performance obligation or to more than one performance obligation when there are contingent payment terms that relate specifically to satisfying the performance obligation or to a specific outcome from the completion of work related to that performance obligation. Now, please keep in mind we're talking here about contingent payment, right? This is not contingent revenue. This is contingent payment, and there's a little bit of, you have to be careful about that. Then the amount that's allocated, including any changes to that performance obligation, needs to be reasonable relative to other performance obligations and the payment terms in the contract. So this is something, again, that's going to affect a lot of us, and I recommend that you think carefully about this. This is a recommendation, or this is a tentative decision, and we need to be very clear about this. Okay? Then the final piece, remember, is continuous transfer of goods and services. Now, in this case, what happens, what we're looking at, is that we're effectively, the principle is to use a single revenue recognition method. The objective of this single principle is to measure progress towards completion in such a way that you are actually representationally faithful, to use an old accounting term, to depict the pattern of the transfer of goods and services to the customer. Right? So we're trying to get to a single revenue recognition method and trying our best to reflect the amount of progress towards completion. Okay. Now, a little bit more on this. So the next point is, how do we determine whether that performance obligation is being continuously satisfied? Vendor performance creates or enhances an asset that the customer controls as performance occurs, right? So effectively, this is somewhat similar to one of the arguments that we have in milestone method of revenue recognition. Vendor performance does not create an asset with an alternative use, and one of the following conditions is met. In other words, as each task is completed, the customer gets a benefit. If not that, then nothing more needs to be done with respect to that obligation which has been transferred to the customer. The third criterion then, or indicator, is that the vendor has an unconditional right to payment for all the tasks completed to date, right? So these are the different ways, and again, you'll see concepts that are similar to what we talked about in the milestone method. Now, the last point here is, with respect to these continuous transfer, how do you establish whether value has been transferred? How do you establish whether any one of the previous three conditions that I mentioned from the form, that slide that we just went through? There are output methods, those that are based either on units produced or delivered. They could be milestones. If you don't have output methods, you can use input methods as well. Input methods would then be, for example, direct labor hours, just as we do today in SOP 81-1. Uninstalled materials, you would only recognize costs upon transfer of control and margin upon installation. So there's been a little bit of additional information there. And then the passage of time, which is, in other words, ratable revenue recognition. But please keep in mind this is not a separate method unto itself. All right? Now, at this point, what I'd like to do is to give you the third and final polling question. And what we'll do is follow this up with two things, which I'll tell you about in just a bit. But here is, and hopefully soon, you will be able to see the third polling question, and that is, do you think that the residual method is something that you strongly agree that it should be part of the final standard, strongly disagree, or you have no preference? Now, of course, no preference would probably be the answer provided by those of you, who don't have to worry about in other words, you have VSO of selling prices, or you can establish the estimated selling prices for the delivered element, right? So that's why I want to see what your sense is of the residual method. And then I also want you to start thinking about something else, right? And that is, should there be a third possibility other than the relative selling price and the residual method? But that we can, I'll have to get that information from you through your questions and so on. see what we've got here. Hopefully you've had some time to respond to this question, and there we are. 48% would like, strongly agree, would like, of course, is not a good way to put that. So 48% for the residual method, 38.7% have no preference, and 13% strongly disagree. So I wonder, that's an interesting split there. I guess we have probably a few more intellectual property and sales and software attendees or participants than we normally do, maybe. But this is interesting. Very good. I'm glad. Thank you very much, Dave. And here we go now for the propaganda part of things. I've just revised my seminar schedule, and later this week I'm offering an updated and very much current 081 and 093 program for 2 days. And then a few days later, May 12th and 13th, we have a one-day session on lessee exposure drafts and one day on lessor exposure drafts. And once again, I will be providing in here specific examples, and I'm going to compare the current accounting for transactions under the current standards for leasing with what is being proposed. And then I've come up, of introducing a new seminar, a day and a half, advanced topics in general revenue recognition. The objective here is to talk about issues in general revenue recognition for which there's little or no guidance in the literature, or a lot of people have restatements because of these and disagreements with their auditors. So those are the three new programs. And then I've got three that were announced earlier. And here we have the advanced topics in software, which is an old program that I've been doing, very successful. And once again, issues for which there's little or no guidance in the literature. And this has been a very successful program, so I do hope I'll see you at one of those two, because I've got one in San Jose and one in Boston. And then there's a half day on the revenue recognition exposure draft on the 1st of June. And that's followed by, of course, the other two, the advanced classes. And then finally, on May 19th and 20th and June 2nd and 3rd, one in Boston, the first one, the second in San Jose, a program in general revenue recognition. They're both two-day programs, so I do hope that I will see you at one or more of these programs, and I look forward to hearing from you. And Dave, we can take a look at questions.
Thank you, Tony. I truly enjoyed listening to you speak. Before I jump to the questions, I'm just going to remind anybody who got on late that you can request your CPE credit. The way you will do this is you will receive an email sometime in the next 2 hours that has a link to a webcast feedback questionnaire. In that questionnaire on that web page, there is a box you will check to request that CPE credit. All right, let's tackle some of these questions that have come in. First one's pretty straightforward, Tony. It's, when is the draft going to get finalized, and when are companies required to implement this?
Okay. So, Dave, you picked a question that I actually cannot answer in the sense that I don't know. And, I mean, here's the thing. The first point, and I'll actually take a look at both of them. The first question was, when is this going to be finalized? Now, I think that part of the issue is that it was expected to be finalized by the 30th of June, but there's so much being changed that I honestly think that it's going to take them a little bit longer than that. But how much longer is a function of how they deal with these issues that keep cropping up. That's why I said at the start of the webcast that you have to be very, very careful. You have to look very carefully at all the materials, and you have to track what the staff is doing. So that's one thing. The second question was, when will you have to implement it? Now, that is actually a function of the method that the board finally settles on. The current proposal is that, you'll have to start applying it once it goes into effect. But that part isn't all that clear. And So this is something that's going to be very, very difficult to say. What I think you need to consider is the boards have said they were going to take a little bit longer. The boards are still trying to get a sense from the community out there as to what method they would like to have for adoption. Because, we know so little about how this accounting standard is going to work. There have been no tests. Nothing has been done in that respect. People have responded. A lot of people responded. The comment letters are definitely very good. They're worth looking at. The staffs of both boards are looking and reviewing and carefully considering them. And yet there's a lot of questions here. So it's unclear. But, I understand that it's an important question.
Okay, let's go to the next question, and this one's a little bit broad too, but you can probably add some insight here. We are using EITF 08-1 in our business practice now. How is the change going to impact us?
Okay. Well, the first thing is that let's think about what 08-1 is all about. It's about multiple element contracts and how you separate them and how you allocate the transaction price. So first of all, the separation criteria have been changed because now we're looking at performance obligations, which is a little more distinct than the previous element or deliverable that we had. The second point is that under 08-1, you were able to use, or you're required to use VSO of selling price if that existed. If you didn't have that, then you use third-party evidence, and failing both the VSO of selling price and third-party evidence, you used an internally developed estimate of the selling price. The first thing is that you can no longer use third-party evidence. So those of you who were relying on it, using it, et cetera, you're going to have to come up with one of the other two. But presumably you were using third-party evidence because you didn't have VSO of selling price, right? So that's one of the interesting issues, one of the places where there will be a change. Because what you're going to then need to do is, if you don't have VSO of selling price, go to an internally developed best estimate of selling price. The other point is that the 08-1 does not permit the residual method. As I pointed out a few minutes ago in the webcast, there are conditions under which specifically software and IP transactions are used as an example in the discussions at the boards where you may be allowed to use the residual method. So the first point is that this will certainly make software and IP companies happy because now they can use the residual method most likely. But again, between now and when the standard gets issued, there might be changes. So the point is that, first of all, those who rely on third-party evidence will have to work more. Those who are using the residual method may or may not, because if the use of the residual method is sort of ring-fenced in certain ways, in other words, it can only be used under certain conditions, then you might have other problems, because quite a few companies use the residual method prior to 08-1. Quite a few companies that are software companies continue to use the residual method because that is still permitted. And the question is, how different is the residual method that they're proposing right now, and will it be more broadly applicable? And then, of course, as I said during the webcast, the fundamental question also that follows the issues that I've been raising is simply the fact that, are there circumstances under which there will be a method other than the relative selling price and the residual method? Okay?
Okay, next question. How exactly is the proposed accounting for contract modifications really different from the current treatment for contract modifications?
Okay. See, the question and the issue that I had raised in here is that the modification, the principle says that you should treat as a separate contract if the price of the modification is commensurate with the value of the performance obligation. Now, does this, for example, mean that, let's take the following case. Let's say that you enter into a rental agreement and you allow your customer, or you rent to your customer some asset of yours. This is not a lease, okay? say it's intellectual property and you're allowing them the right to use it for a year. You start the agreement on the 1st of January. On the 1st of July, since Dave is the national sales manager, he comes into you, to your customer, and he sells to his customer an additional 6 months. Okay, so he's now extending the contract from 1 year to 18 months, but he's 6 months into the contract. Keep that in mind. Now the question is, when we look, first of all, do you treat the 6-month extension as a separate contract? Next point is, if the price of the modification is commensurate with the value of the performance obligation. One way of thinking of that is that what that means is, if you normally charge $6,000 for 6 months, okay, then when Dave modified, if he sold it for $6,000, perfectly fine. But what if he sold it for more or less? How are we going to treat discounts? The other point is that what if the modification is actually not an extension? So it's not that you're doing the same thing, but what if the modification involves doing something else? So you see, what's happening here is that, this is sort of emblematic or identical to what normally happens with many of these standards. We're moving to principles-based standards, which raise a lot of questions, require a lot of judgment. So the point I was making is that given the way the modification principle is stated here, in the absence of implementation guidance, which is likely, so in the absence of implementation guidance, will we get the same result as we used to under modifications? One. Second question. Will we be able to compare companies? Is it possible to get disclosures that help explain that? And these three, I think, these questions I'm asking because my concern is that it's actually not going to be possible to figure this out. So the question is, it seems to me potentially quite different, but this is where I'm working. These are the kinds of things that I'm trying to understand and explain to people, my clients, for example, and in my classes, that these are the questions that it would help you to start thinking about right now, because these are the issues that you're going to have to resolve for your companies. So I think it's a very good question. How different is it really? And I think maybe the fundamental distinction here stems from the fact that we've got a broad principle without, at this point, please don't get me wrong, I'm not saying there won't be. All I'm saying is at this point there isn't implementation guidance, right? So that's the issue. How is it going to differ? So I hope that makes sense.
Okay, I think we've got time for one more question, Tony, and this is around SaaS companies, and I'm actually going to read two of the questions because they're very similar. Do you see SaaS companies struggling to see how they fit the standard, and what would be the best resource primarily around the accounting for a software-as-a-service organization and the revenue recognition treatment for subscriptions, one-time fees, and professional services?
Okay. I think that was a multiple-element question, Dave.
Yeah.
Yeah. And let me see if I've got all of them. The first thing is that at the moment, the way the standard has been developed and has been developed where it is right now, there is not a word about any separate issues for cloud computing at all, or software as a service companies. These companies effectively are, going to be doing what everybody else is doing. That's one thing. Second, there is much, much more information about which costs can be deferred. So from that perspective, I think cloud computing companies are going to be helped by this standard, because it's a question that we had not answered at anywhere. The boards hadn't dealt with it. The EITF hadn't said anything. None of the standard setters had said anything. But finally, the standard does have, and I think it's a very good thing, it has information about which costs can be deferred and so on. So that's going to help. Now, the other points that were raised was one-time fees or consulting fees and so on. There the issue is, there isn't much in here right now but I can see having to be able to demonstrate that it's not a setup arrangement, right? It's not what you're doing in that one-time consulting arrangement or whatever is not something that's going to allow the customer to actually use the product that you have better and so on. So that's part of the issue. The second part is that if it's truly one-time, then yes, you'll be able to separate it. You'll be able to recognize it on a timely basis when you're done. On the other hand, if it's not, then I think that the basic system that we had before, that is the amortization period, should be a function of the term over which the customer benefits. Now, once again, this is an inference. I want to be very, very clear. It's an inference that I am drawing. There isn't much detail in this standard, as I said before. They're working on it. But in general, I think it's possible that cloud computing companies may actually be somewhat better off. And as I said, I do offer courses in cloud computing and software as a service transactions. And you can always, hopefully soon, in about 2-3 months, I'll have a book on accounting, financial reporting problems in cloud computing. And you can always drop me a line. Here's the information. You had, I can actually, let's see. There it is. Sorry, just for a second, Dave. But here's the website, acsondhi.com. And there's a telephone number there. You feel free to call about these programs and so on. Okay, Dave, it's all yours.
All right, I think we can wrap this up. I believe everybody probably registered through one of these two sites, but if you're looking for more information on SOFTRAX, that can be found at SOFTRAX.com. If you're looking for more general information on revenue recognition, you can find that on SOFTRAX.com and RevenueRecognition.com. Please feel free to contact us if you're looking for more information. We'd love to hear from you. You can also ask your peers using the RevenueRecognition.com forum. And if you just like a direct conversation, you've got Tony's information. You can contact him, and I can give you my number. Here is 303-SOFTRAX. That's SOFTRAX, 303-763-8729. We are at the end of our presentation, and I would like to personally thank you, Tony, for joining us and presenting today.
Thank you, Dave.
And everyone else for joining and sitting through. Thank you very much.
Ladies and gentlemen, that does conclude the conference call for today. We thank you for your participation and ask that you please disconnect your lines.